Welcome to Moffat and Money. I'm Clay Moffat, and today we'll do a quick hit on the jobs numbers that just came out. The BLS this morning reported the U.S. added about 528,000 jobs. Pretty good number. It was double the 250 expected. This compares to last month's 398. Now, so is that a good number? Is that good news? If you got a job, it's probably good news. If you're in the market, maybe you consider it as bad news. It's confusing news, actually, to the market. First of all, you have to understand the market for the past, well, since the financial crisis, has gotten very used to the Fed's QE and liquidity programs. And what do I mean by the Fed's QE and liquidity programs? Well, if we look, let me bring this up. If we look at this slide, and this goes back to March 9th. It's only through about 2013, but it demonstrates the point. The Fed had several what it calls liquidity programs, QE1, QE2, twist, and then extension and QE3. These programs were basically the Fed forcing rates down to zero. Now, the way the Fed controls money supply, the way it controls interest rates is the way it controls the money supply is by raising or lowering interest rates. Obviously, people want to borrow less. If the cost of money is more expensive, they want to borrow more, generally speaking, if the cost is less. So, how does the Fed adjust interest rates? Well, they have several tools. One, they can go and hike the Fed funds rate. This is kind of the bank's underlying cost of funds if the bank has to borrow money. So, raising that rate forces the banks or encourages the banks to raise their rates. Secondly, what the Fed has actually done is go into the market and buy securities, bonds, mortgage-backed securities, and it's made money available to the 36 largest banks called the primaries, banks that have a unique relationship with the Fed, by offering them basically free money. Zero cost money or money at very, very low cost. The Fed funds rate, the short term rate has been 0.10, 0.15, 0.20, when historically it's about 3.8 or 4%. So the money cost is a fraction of what historically it has been. And the Fed does that to try to incentivize the banks to borrow money and then hopefully lend it out. Well, they've been borrowing money, but nobody wants to borrow money. They've lost their jobs. They can't afford new houses, on down the list, at least through the years of the subprime crisis and the poor economic recovery. Well, if you look at this, the banks still borrowed money. But what they do with it? Well, obviously they bought some bonds and mortgage-backed securities, sold them back to the Federal Reserve, but they also participated in the market. And what's the evidence for this? Excuse me. Well, if I look from the start of the QE programs, this chart right here, the blue, the QE1 expansion, you'll notice the market goes up strongly. And then when QE stops, the market goes down. The light gray is when there's no QE program active. Well, then Bernanke activates what we call the Bernanke put. When the market falls far enough, Bernanke would step back in and start another QE program. And this happened repeatedly. And then it went to the Powell put, the Yellen put, and then the Powell put. Well, here is QE2. Once the market's dropped, QE2 started, the market's back up. Well, QE2 stops, and what happens to the market? It drops sharply. Okay, Fed steps in, puts in program called Twist, basically another QE program under another name. This is more oriented towards mortgage-backed securities, and you see the market again rises. There's kind of a rumor here at the peak that QE is going to stop, so the market drops, but Yellen, Bernanke announce another extension, and the market continues the rise. And if I extended this chart out, and I probably should need to update it, but if I extended it out, you would see that pattern continues. The market was driven by the Federal Reserve's free money. not really a healthy, normal market. So, getting back to our numbers, what does this mean for us? Well, understanding that the market is relied on the Federal Reserve, it doesn't want the Fed to stop the free money. It loves the free money. And so if the Fed stops that and tightens interest rates by tightens the money supply by hiking interest rates and reducing its balance sheet, well, the market's not going to take that as good news. That's why, even though with a good jobs report, the market's down now. The news, good news may be taken. The point is, good news may be taken as bad news by the market, because how it really decides whether news is good or bad is based on expectations. The market was expecting a much lower number. It came in much stronger, which means the Fed is probably going to continue hiking rates, maybe even needs to hike them faster. So the market takes that as bad news. Now, you have to understand in the market that expectations, perceptions are everything. The reality is usually after the fact. It's like J.R. Tolkien once said, a single dream is more powerful than 1,000 realities. And that's very true in the market. Now, many are arguing that this payroll number is proof that there's no recession, despite the fact that GDP has dropped for the past 2 quarters, last 6 months, which historically is the definition of a recession. So the number is very confusing, given that you would expect if business was dropping that firms would hire less. And also, if we look at today's payroll number in context of other numbers released this week, even yesterday, it gets even more confusing. So let's take a look. Here are here's a graph of the initial jobless claims and continuing claims. Now, initial claims are those filing for unemployment for the first time. And you can see since April, this has been steadily rising, not a good trend. In understanding where the market's going, you're generally better off following trends, not looking at just one number pops, because you can get aberrations, you can get weird numbers, and we'll explain that in just a second. We also look at continuing claims, which has been steadily, rising. These are the people who can't find a job and have to stay on unemployment. So that number is continuing to rise as well. In addition, the labor participation rate was dropped. And if we look at that, labor participation rate has been declining for the last few months. Now, this number is simply the total of number of workers available in market versus how many of those are working, the percentage of those that are working. So on one hand, the government, the BLS, is saying, hey, there was a lot of hiring, a lot of jobs creating. On the other hand, it's saying workers as a percentage of the workforce are declining. That's a little contradictory. Also, if you look at announced layoffs are rising. Here's, a website that kind of lists or keeps track of a lot of the job layoff announcements. Walmart's cutting, Robinhood is cutting, Oracle is cutting. So far, 32,000 workers have been fired in tech. Ola's cutting off. Shopify is laying off. Coinbase is laying off. Amazon is laying off. Twitter is actually laying off. Meta, Facebook is laying off. Rivian is laying off. Microsoft's. You get the trend. Ford just the other day announced 8,000 layoffs. So the announced layoffs are rising, and they're getting to be some pretty serious numbers. So with the decline in labor force participation, with the increase in layoffs, with the increase in jobless claims, things just don't add up. Now, if we look at the actual statistical significance of the payrolls number, it's what we call a 6 sigma beat, sigma being standard deviation. Now, I'll explain the significance of U. This is a statistical analysis, here's a normal curve, okay, with the median being the mean. You've got 50% of the observations below that, 50% of the observations above that. The area under this curve, the blue line, is a probability. It sums to 100% or 1. So if you like the mean here, 50% on one side, 50% on the other. Well, versus, and you can see the previous numbers that have come in over the past year where they stood. Well, the one released today is 6 standard deviations off the norm, off the mean, which is statistically huge. Now, without going into a lot of the detail, if I take this mean and add 1 standard deviation and subtract 1 standard deviation, I create a range of observations. That range is going to be 66% of all the possible outcomes. If I take plus or minus 2 standard deviations, that's going to give me 95% of all possible outcomes, a 95% probability that whatever happens falls between that high and low. If I take that mean and do plus or minus 3 standard deviations, that gives me 99% of all possible outcomes. Now, we're 6 standard deviations above the mean. So that is a fraction. The probability of that occurring is a fraction, a very small fraction of 1%. That's how weird and unusual this number is. So why is it that extreme? Can't give you a solid answer because the BLS doesn't give us good information on how it compiles and adjusts the number. It actually adjusts the numbers. These aren't specifically the survey results. They don't release those. But they make what they call seasonal adjustments. And these seasonal adjustments are basically mythical changes to the real numbers that they get based on what they think historically has happened during that season. Now, they end up every few years having to readjust and recompensate for the bad seasonal adjustments. So it's very likely this has a huge or significant seasonal adjustment in it. So take it with a grain of salt. Also in the report, we saw where wages rose, but still less than inflation, which means in real terms, you're still purchasing less with your paycheck than you did last month. And that's gone on for 17 out of the last 19 months. If you got an average raise. Obviously, if you haven't gotten a raise, you're even worse off. Now, one other quick note, if hiring is this strong and production, GDP, is declining, then the amount produced per hour of workers' time or workers' pay, which is still going up, declines. That's productivity. So the amount produced by each person is falling. That's never a good trend. And that bodes very poorly for the future. If that's happening, and it is, productivity is getting eviscerated, it's getting destroyed. Companies will have to greatly increase their prices and charge more, or they're going to have to start seriously laying off people. Only 2 choices. Now, you're the head of a company. What do you choose? There's not a good choice. So we'll just have to keep an eye on it. Don't be surprised if the market's kind of wanky, but we are having economic distress and problems. We are most likely in the middle of a recession. It's probably going to get worse. So we'll see how worse. Well, just tune into my videos in the channel, turn on the likes, turn on the YouTubey things, turn on the subscription things, Do all that stuff, and we'll continue the discussion later. Feel free to comment or ask me any questions on at the Twitter site, Moffat on Money. And my time is up. I thank you for yours.